Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullinton Capital Report, hosted by Bill Bullinton. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullinton.
Well, welcome back. And like the man said, this is Bill Bullinton, here every Saturday morning from 11 to noon. Been here for an incredibly long time. It's hard for me to believe, actually. But anyway, I thought we'd spend today talking about some of the basics, going back and reviewing the fundamentals. That's very important. It's tough to keep on your mind, especially when you're in the heat of battle. That's one of the reasons that professional sports teams have coaches. The coaches, it's not like the professional athletes don't know what they're supposed to do. It's just that under the stress of the competition, they may forget, and the coach is kind of there to remind them what they already know they're supposed to do. And that's kind of what being a financial advisor is like. You can go over this stuff, and most of it's not that complicated. The complicated stuff that arises, I'll talk about that in a little bit later in today's show. But the complicated stuff can be put in a more simple fashion, much more simple than you're going to read about it in the newspapers or on things you'll see on television. And there's a reason for that. They have to sell advertising. That's what pays all their bills. It's a huge industry. And if they told you what really mattered the most, and that it's going to have 95% of the influence over whatever it is, whatever topic it is that you're interested in, then you wouldn't be watching as closely. And I think they're wrong, actually. I think that 5% of this stuff that you really need to know, that you really need to get down, it's like baking a loaf of bread. You get all the ingredients. Yes, it's important that you know what all the ingredients are. But, man, you forget that little bit of yeast, and you've got a flatbread. Still bread, it's just not what you had expected. And that's kind of what financial services are like. It's hilarious. There's certain things, they're very small in number relative to all the items that are out there in personal finance. Just Google that sometime. But they're incredibly important. And without it, you're just not going to do well. And I'll even tell you what it is. I'm not going to keep you in suspense. It's literally, how much do you need to live a lifestyle, comfortable lifestyle for you? And you take that number, you divide it by 4%. That's called the 4% rule. Well, first, before you do that, in fact, you should go out and check with Social Security to make sure that they've caught everything and that you get a report. It's free. You can go online, just Google Social Security, go on and set up an account. If you have a pension with the company that you work for, get an estimate of what that pension may pay out, and that's the money that you're not going to have to plan for, because it's going to be provided by either Social Security or your pension. The pensions are technically they have more risk than Social Security, because Social Security is backed by the United States government, and the pension has a guarantee fund behind it. But if the company messes up a lot, you can get a pay cut in that. So that's a topic for another show. But anyway, you want to get your estimates on all the income that you have coming into you that are guaranteed payments. Again, the guarantees on a pension are not quite as good as a guarantee from a government agency, so you might want to take that into account. But once you get that number, and it's going to be, typically it's less than what you're making on an annual basis. And most people are going to need somewhere between 70 and 80% of their pre-retirement income when they retire. So what do I mean by that? Well, if you were making $100,000, you're going to need somewhere between $70,000 and $80,000 a year in retirement. Why is it less? Well, because you won't be going to work. And by the way, it's all over the map. But you won't be going to work. You won't be buying things for work, paying for lunches. Also, you're not going to be putting money into your 401k plans in your retirement. You're not going to be contributing to those anymore, so that saves you some money too. You add all that up, and typically you need somewhere between 75 and 80% just to match the current lifestyle that you have today. You know, if this is going too fast, and I'm pretty sure it is, especially if you're driving, don't try to write this down. You can go to my website and you can download this as a podcast. And you could call me, and I can go over it. I've been doing this for so long, I can literally do a retirement plan. I think it's pretty funny. Ken Fisher says, the 15-minute retirement plan. Well, man, he must be slowing down. He's a lot older than I am. Because literally, if you can't do this in about 10 or 15 seconds, you haven't been doing this long enough. That's my feeling anyway. So if you tell me how much money you need at age 65, I can tell you in literally 15 seconds how much money you need to have saved to supplement your other sources of income. Now, this is where it gets interesting. Everybody has a different risk tolerance. What is a risk tolerance? Well, if I have a portfolio and it's out there in front of me, I'm looking at it, and let's say the stock market goes down percent and mine goes down 7%. Okay? I am probably somewhere around 70% invested, if that makes sense, in stock funds. Okay? Probably. Do I feel bad about being down 7%? Yeah, probably don't feel good about it. But am I losing sleep over it? Me? Probably not. Actually, I'm not losing sleep until I'm down over 40%, and that's how I'm running mine. Like I have a 40% decline tolerance. If I'm down 40%, I expected that to happen. It's not going to have an impact on my lifestyle, and so I can put up with that. And that's basically how we set our risk tolerances. And I'm so excited because this is the first year. Every year I've been monitoring the most popular financial planning software packages that advisors use. And this is the first year that they have come around and they're using something very, very similar to what I am, to what I've always been talking about on this show. Imagine, this is your assets. If you're 100% invested in stocks, you can be down 50%. The stock market's been down more than 50% 4 times in my lifetime, and I am not that old. And by the way, when it goes down like that, it takes a long time to come back. It takes a long time to come back. So, and you can't avoid it, by the way. Well, you can avoid it. You can stay out of the market. Most people think they're going to stay out of the market during bad times because it's obviously easy to see that coming, and they're going to get out and then get back in. No, you won't do that. I've never met a single solitary soul that can show me statements that shows me where they're getting in, where they're getting out. So the alternative, the only viable alternative, as far as I'm concerned, is you have to think really hard to yourself. Ask yourself, how much am I willing to be down on this? And by the way, both Warren Buffett and Peter Lynch, a guy hardly anybody remembers anymore, he just was the #1 mutual fund manager of all time. He holds the record for highest returns over the time that he managed Magellan Fund. It was 13 years, and he managed close to 30% a year. That's mind-boggling. By the way, half the people more than 50% of the people in the fund lost money while he was managing it, because you don't get those types of returns with low risk. That does not happen. That only happens on Facebook ads. So his fund was very volatile, and only the people that got in and stayed in and stuck it out were the ones that got the returns. And it was literally less than half the investors. So it sounds easy. When I'm talking about it, here's your assets. Imagine that they're cut in half. Are you still sleeping at night? If you're not, we can't put 100% of your assets in stocks, because if they ever do, by the way, there's nothing saying they can't go down lower than more than 50%. They did in the 1930s. I think from the peak to trough was 85%. So how do you manage that risk? And then that's gonna be the key towards a successful retirement. It's not budgeting for the trip of a lifetime that you and your spouse or your family are going to take on a ocean voyage that lasts a year. Very few people can afford to do that. And a lot of the ones that can afford to do that, they're not going to do it anyway, because that's how they got the ability to be able to afford by doing that, is by not doing it. And it's a very different reality over my lifetime. You read about a lot of these things, people taking the trips. I'm going to get my Lamborghini, park it in my garage during retirement, and I don't know. They pump your heads full of stuff, and I got to tell you, just to be able to let's see your number comes back at $40,000. I need $40,000 to supplement my security and my pension to be able to reach that magic number of 80% of my income before I retired. And incidentally, that's all over the map too. That's for people who have had a job, who have worked for other people. If you're an entrepreneur, then like me, your income is all over the map. My income is tied to the assets that I manage, and so it's down fairly significantly because the stock market's down fairly significantly. And when my clients' accounts go down in value, I get paid less. When they go up, I get a raise, which is great. That means that my interests and your interests are perfectly aligned. You do better, so do I. You do worse, so do I. And you got to have you just have to understand that that's kind of the way it works. You're not going to be able to avoid the big declines. You can cushion them, and how you cushion them is going to go back to that question: how much risk can you afford to take, or how much risk do you want to take? By the way, those two things are not always the same. Another reason to talk to an advisor, sometimes it helps just to talk it out, and sit down and go through look at the graphs, look at the markets, look at the funds that you're talking about investing in, and how have they done over the past 10, 15, 20 years. What are their increases? What are the decreases? Do you think you can make it? How much are you actually going to have to spend in retirement? Is that going to be any different than what it is today? There's a lot to talk about, but in the end, it still comes down to some pretty simple things. How much money do you have? Multiply it by 4%. Is that going to be enough to be able to help you keep your lifestyle? If not, then you've got some tough choices to make. You can cut back on the lifestyle. You can increase your working. By the way, I can't wait until I can afford to go work at Lowe's. I know everybody thinks I'm kidding when I say that, and I'm kind of kidding. But when I can afford to go work at Lowe's, then I'm going. My dad was a carpenter, and he used to talk about sawdust getting in your veins, getting your bloodstream. What he meant was you can get hooked on that vocation. And I was right. I worked with them for a couple of years after I got out of school, but I just felt like I just can't make enough money this way. And When he had me on the job, by the way, he was always taking these jobs that he would have never taken by himself because he couldn't lift that material up on those roofs. That was my job. So I saw the writing on the wall. That was never going to change. But I really liked it, and I just didn't feel like I could do that well in that industry. And I had, long story short, I wanted to be a pilot from the time I was a little kid. I got an aviator slot in the Marine Corps, went through officer candidate school, was going through officer candidate school, got appendicitis, had my appendix removed 2 days before I had to report to Quantico. That's where they do the officer training for Marine Corps, or did at that time. And so I couldn't pass the physical because I still had stitches in my abdomen. Shot that dream all the way. And that's why I ended up working with Dad. I just had to come back, do something. And I didn't work with him that long during that period. I'd worked with him off and on every summer. And a few months after school was out before I had to go to. Anyway, long story short, I have done a lot of that stuff, and I think it's really interesting. People in those fields, they basically, if you're a contractor or a subcontractor, you don't know what your income's going to be. You're going to have to figure out how much you think could live on comfortably, and then how much are you going to get from Social Security. You can take that away from that other number. All these numbers, by the way, have to be adjusted for inflation. When you go to Social Security Administration, they'll give you an estimate of what you're going to get, and most of your pensions are going to give you an estimate of what you get in today's dollars. They don't know what the future is going to hold for inflation, and most of them are going to adjust for inflation down the road. And I was just notified. I've got just about 40 seconds before I have to take a real quick commercial break. So if you'd like to call in, 216-901-0945. I'm actually broadcasting live today. And this is Bill Bullinton, and I'll be right back after these commercial messages.
A thousand generations falling down in worship to sing the song of ages to the Lamb.
And we're back. Hey, this is Bill Bullinton. I'm here every Saturday morning from 11 to noon. If you hear something you'd like more information on, or you just like to set up a call and talk about your own situation, you can call me at 330-664-0700. And by the way, this is how I speak all the time with everyone. So if you don't like what I'm saying now, don't call. I'm just kidding. But actually, kind of. But anyway, somebody was asking me why I would like to work at Lowe's. Well, I can't afford to work there now. It just doesn't pay enough. But when your father's a carpenter and you're working and you spend a lot of time doing a lot of stuff, and again, he used to say you'd get sawdust in your veins, and basically you just became enamored with it a little bit. It's amazing how much that industry has changed. It's changed as much as mine has over the years, all the tools and stuff that you have. That's the thing about a job in whether it's carpentry or it's financial planning. The right tools make all the difference. It's unbelievable how tools can affect the outcome. So you just want to make sure you got the tools that are up to date. For us, that was nail guns were a big thing. It really sped up the process of building stuff. And the original tools were really kind of bulky and difficult to deal with, and then they just got better and better. Now I see people using them all the time. But I feel that way about the stock market. Tools have gotten a lot better over the years, and now it's not as difficult to find the right products as with a lot less work. And as I'm saying that, there's a product that I used a lot. It's called TC2000, and it's a stock scanner. I'm not advocating for most people to do stocks, especially if you're a retiree. Individual stocks, I mean, if you want to buy and hold a few, that's fine. And I'm going to go back out and find that little booklet I published a long time ago. And I'm going to rewrite it. It's really the size of an essay, and those are the most important things that are going to have an impact on the stock's value and the company's value in the long run. And the idea is that you want to get stocks whose value will be higher in the future. Incidentally, that's incredibly difficult to get right. But those companies that have a tendency, like the Procters and Gambles of the world and the Clorox and Hershey's, they have a tendency to have certain things in common. And that's going to be an entire show by itself one day. So when you have these ideas and you've got the right tools, it makes the job a lot easier. It's never a cakewalk. I mean, I don't know anything in life that's a cakewalk. And it's one of the reasons, again, you just want to have things really simple. You know, with my dad, we used to build an entire garage, 16 feet by 24 feet. Reverse gable, if you know what that is, doesn't matter. If you don't, it's a two-car garage, and it would have a roof on it, a normal roof. There were some roofs that were flat and shed. Let me just skip all that, just so it had a normal roof on it. And three of us could go out and build that from scratch in a day. And there were none of the materials were pre-cut. The walls weren't pre-made. We weren't putting up pre-made rafters. Everything was cut by hand. We nailed everything by hand. When the nail guns came in, we actually started getting off early. But the bottom line was we had done that so many times. It was kind of like factory work. Nobody even talked. I laughed one time because we were building a garage for some family, and the guy comes out and says, man, you guys are pretty fast. I was like, oh, yeah, thanks. And he goes, but you don't talk to each other. And it just dawned on me that we didn't need to talk to each other because we knew exactly what the other person was doing, what was going to be done next. And when you finished with whatever you were doing, you looked up, knew what the next task was, and you just started working on it. And that's how you want to get with your financial plan. I'm telling you, it's not that difficult. Yeah, sometimes it can be difficult, but the vast majority of the time, it's not that difficult. And where the difficulties come in, it's not should you do this or should you do that. It's, okay, I've got a situation here that's kind of complicated. I need to put some money aside for this person or this charity, and I just need to know what the best way to do that is. Or I've been married more than once, and I have 4 kids. How do I set that up? Well, there's no one right way to do that. There are lots of ways of getting it done, but there's no one right way to do that. And so you're going to have to, those are tough conversations because you have to make decisions that are based on emotional, how do you feel instead of what's going to net the most amount of money. Okay? And there's not always a right answer for that. That's one of the reasons financial advisors, I think, will probably, even in the robotic age of investment management, will probably always have a job because, at least for the next 10 years, it might get better. They might get better and start rolling that stuff out, but by the time that happens, I will probably be retired. If I ever retire, I don't know why I'd want to. I can always cut my hours down and take a part-time job at Lowe's to stay busy. I'm telling you, it's really important to stay busy when you get to retirement age. You've got to find things to do, things to take up your time, because you're going to end up having a lot more time than you probably thought you would in most cases. So there's a monetary side of financial planning, and then there's a personal side. What are you going to do? Quite frankly, I like my job so much. I just don't think I'll ever quit. It's fact. It's more challenging today than it was 10 years ago. You should see how much faster laws change. That is mind-boggling. And every day there's something happening. How are you going to qualify if you've got kids and they're going to college and there's student loans out there? They keep for the last 2 years they kept talking about giving relief to kids and parents over student loans, and they keep making changes and coming back out with it again. And as far as I know, it hasn't been finalized, so I will look that up for next week's show. But in my industry, something's always changing. And it's crazy. And I get it. When you are a relatively small, I think we're roughly 5% of the world's population here, and somewhere around that number lives in America. But 30% of the lawyers live here. That means that they've got to keep finding things to do. And so we get legislation that changes fairly frequently. It's called job protection. Yeah, not real fond of it, but that's okay. It's just the way it is. That's the way it goes. We've got a lot to be thankful for in this country. A lot. And mind-boggling. And it does run really well, but I am getting off subject again. Oh, by the way, on the fixed income side, stocks, bonds, cash. I'm going to have to start saying stocks, fixed income, cash, because on the fixed income side, you can buy bonds, but bond prices move a lot, and a lot more than they used to. And it's not just interest rates anymore that make bond prices go up or down. In the old days, if they started to raise interest rates, bond prices are going to drop. Yeah, okay, good. Now it's like, hey, bond prices dropped. Why did they drop? Well, because somebody's anticipating that something's going to happen in the economy, and then they're going to move interest rates. So they're a lot more volatile than they used to be, or than I remember them being 15, 20 years ago. And so you got to be careful with that. It can be very unnerving. You put money in a aggregate bond index like the one from Vanguard that was typically, it's like the S&P of bond funds, and that thing is down huge over the last 3 years. 3 years in a row. It's coming back now a little bit, just a little, and but you don't expect that. So that's one of the other things that you as advisors out there, if you're not, a lot of the advisors haven't been around to see a lot of movements in interest rates because they're just too young, and they've never really thought about it too much, and all they really looked at was the current yield and how attractive that whatever it sounded. See, you can put government securities in the name of a fund, and it sounds really good, government securities, and then you get the ones with the highest yield. And by the way, government securities move as much as regular securities do. So the risk, interest rate risk on them is extremely high. That means if interest rates go up, their prices are going to go down, which they do quite a bit. And if you don't know that, well, it's really a tough way to learn it by having your money invested that way, because you may not make that money back for a couple decades. That's crazy. Who wants to do that? Anyway, then that's one of the reasons when you get closer to retirement, you really might want to consider looking at fixed or fixed indexed annuities, because they're offering higher interest rates with guaranteed principal. The guarantee is only as good as the insurance company. So you want to make sure that you're doing everything you can to find good insurance companies, because oftentimes, just like everything else, if a company is small, an insurance company is small, and nobody really knows a lot about them, one of the easiest ways to get more business is to be able to offer higher interest rates. Well, when you're doing that, you're subjecting your company to risk. Maybe you'll make it. I hope they all make it. But anyway, it's just a really important thing, and I generally won't use a company unless it's rated A+ by AM Best, and that's not a guarantee either. That's just a minimum for me, and I have to be familiar with it. And I've got a couple that I really like a lot because they're very highly rated, and they've been around for a long time. And the interest rates are generally, 1 to 1.5% higher than the highest CD rate, but if you're not spending it, it's tax deferred. You won't have to pay taxes on it until you start to take it out. And even then, there are some techniques you can use to reduce the amount of taxable income that you're going to get when you do start to take income from it. So that's about all I'm going to say about that. Generally, it's tax deferred. Generally, the interest rates are higher than what you can get in CDs or treasuries, and those two reasons alone. Oh, and they're guaranteed. So those three reasons are the reasons to take a look at that. And again, like I said, normally you're going to see somewhere between 1.5% higher than you will in a CD, though not always. It's not always that way. But that's one of the reasons people have a tendency to like them. They do have higher guarantees in a lot of cases. And the fact that they're tax deferred, you don't get a sales charge up front. You got to be careful because a lot of them have penalties if you take the money out too soon. Most of the ones that I use have an 8 or 9 year, where if you took it out the first year, you could get as high. I think the worst one's a 9%. So let's say you put your money in there, and the stock market crashed. Well, that was a fixed annuity, so you're not participating in the market in that one. And you decided that you were so scared you were going to take your money out of everything and go stick it under your mattress. Well, you might have an 8 or 9% penalty to pay, but it wouldn't be a 50% drop or a 20 or 30% drop the way that the stock market was. And if you left it alone, nothing happens. I mean, you just continue to collect the interest on it and just let it go. If you wanted to take, they also have early withdrawals without penalties. So most of them, the most common one is 10%. So if you needed some extra cash, you could take up to 10% of that without paying a penalty on that. Some of it's going to be subject to taxes, and that depends on how much you put in, how long it was in there. There's a bunch of stuff, which is one of the reasons you might want to talk to an advisor when you do this kind of stuff, because if you think you're going to need to take out a chunk of cash at some point in time, you're going to want to plan for that ahead of time. And it's almost never the things that actually happen. It's the things that happen that weren't expected that make people upset. So those are a pretty complicated product. They do have some simple ones, but a lot of the ones that have the bigger benefits are oftentimes a little bit more complicated. So if you think that something that's paying a fixed or guaranteed rate of return that's typically higher than what CDs or treasury bonds are, they're tax deferred. There are when you start to take money out of it, you can kind of control the amount of income, or you can absolutely control what you're taking out of it. But you might get some tax breaks on that end too. So it's all it's one of the reasons you might want to talk to somebody who deals with this, that's been dealing with it for a long time. And I will tell you, there are a lot of people that come into the industry and start selling product before they actually know, what they're selling. So it's tough. It takes a long time. As somebody who's been doing it for a long time, whenever they're making changes to new products, some of them are significant, and they're always changing. So, but it goes back to what I was talking about earlier. Got to try to simplify it. What is this for? Why do you want to have it? For me, I have one. Actually, I have two of them. But I want to make sure that when I hit that full Social Security age, I'm taking it, and I'm going to keep working. Because I'm not going to by the time I get there, it's probably going to be 70. but yeah, especially the way they're going with I don't know about the government, man. But at 67, I'm able to take full Social Security. Everybody is. So today, you can take it without getting penalized. Yes, it does. It does go up if you don't take it. But I figure at that point, I'm just going to take the money and reinvest it. I'll just invest that money and leave that as just part of my investment portfolio. but I heard I only had about 60 seconds before I have to take a real quick commercial break. So if you hear anything and you'd like to talk about it, feel free to give me a call. And my website has my phone number, which is 330-664-0700. That does go right through to my cell phone most of the time. And if it doesn't, it's because I've got my phone turned off or it's recharging or something. But you can go to BullingtonCapital.com. You can also reach out there. Just go to my website. Say, hey, I'd like to talk to you about this. I have a situation, and I'll give you a call back. I hear the music. That means I got to take a quick commercial break. It's Bill Bullinton right here on 1420. I'll be right back.
When I think my faith isn't big enough to make this mountain move, when my strength's finally given up, I've done all I can do. I saw mercy, mercy seated where the judge should be was guilty.
And we're back. Hey, this is Bill Bullinton. I'm here every Saturday morning from 11 to noon. If you'd like to set up a phone conversation or you'd like to come into the office, there's no charge for that. I would gladly help you look over your stuff. Like I was talking about earlier today, when you've been doing this for as long as I have, it literally takes me about less than 5 minutes to figure out how much money you need to maintain your lifestyle and what kind of investment portfolio you should have. So, by the way, we're not a low-pressure firm. We are a no-pressure firm. So the way that I am right now is the way I am all the time. So if you don't like me now, you're not going to like me later either. Just kidding. But kind of. Anyway, I promised these guys, a bunch of my clients, that I would take the last 15 minutes of each show and talk about stocks. Because they remember days when, that was the major focus of my business. And that's what they're interested in. So the last 15 minutes, I'm going to sit and talk about stocks, individual stocks. Now, the way that I like to do stocks is there were some money managers that were around back in the day, and they were technicians. What's a technician? Technician is someone who looks for price pattern movement and tries to identify price pattern. And by that I mean stock is doing something. I'll give you an example. Quad Graphics. It's the very first stock on the scan today. It made the scan. Okay. So the criteria of the scan is that the stock in the past 90 days has been going up, and it's in the top 20% of all stocks as far as how much it's been going up over the last 3 months or last 90 days. And today it's got to close at a new 30-day high, and the volume's got to be above average volume. Okay? So that's basically it. Now, there are some other patterns that I don't put into the scan because you can't, if you put too many criteria on, you're going to block a lot of stocks. It's impossible. In other words, it's impossible to get too granular without eliminating almost all stocks. So part of it, you still have to do this by hand, just going through and looking at the stocks that make the initial screen, because there were 36 stocks that made the screen on Friday or yesterday. And the first one is the one I was talking about. It's Quad Graphics. And I look at this from a technician who's has been doing this for years, and to me it looks pretty good. It's got more than one thing going for it. Having said that, this is what's really tough to teach people who don't trade. And by the way, this is I had a client that just passed away, and his name was Al Bernasiak. He was the nicest guy. And he was the one that I showed this to. We were doing this when he first started investing with me over 20 years ago. And, boy, I'm going to miss him like crazy. And he was just a most laid-back, nice person, understood this process. And, boy, when I was younger, this actually worked a lot better back then, by the way. It still works, and it worked well. but it's not as productive as it used to be. Let me put it that way. And but boy, we hit a couple big home runs, and he already always remembered that, and just super nice guy. So anyway, Quad Graphics, QUAD is the symbol, and it closed at $5.10. By the way, most people love the cheap stocks because they can buy a whole bunch of them. What they don't realize is that stock only has to drop by 50 cents, and it's going to be down 10%. So cheap stocks have their own challenges. But for me, it's kind of a classic-looking pattern. Will it go or not? I don't know. When you're doing this is trend following. That's what it would be called from old technicians who actually understand that and did it. It's not as popular as it used to be. There were people that got really, really, really rich doing this back in the 70s, 80s, and 90s. The mind's going on me, in commodities. Actually, the John Henry, the guy that owns the Boston Red Sox, he's the guy. He did this, and he never went to college. By the way, he started trading using these techniques when he was 17 years old. His dad was a floor broker, I think, in one of the major commodities exchanges, and he learned this little methodology. And let me tell you something: you're doing that in commodities, the average swing for the account, you just can't look at it. It goes up and down so much. But with stocks, it's a little easier, not a lot. But if a stock is going to make a big move over a relatively short time period, it's going to show up on one of these scans multiple times. So if you miss it the first time, maybe you catch the third move. It's going to be higher than it was the first two times it came up, but so what? And this is something to do if you just really like doing it. It requires an enormous amount of discipline. And next time we do a seminar, I'll bring this stuff up, and I'll probably write it a little book again. That's very difficult for me to do because I'm so critical of my own writing. But when I see what I'm seeing here, that's kind of what gets me excited. I haven't seen scans like these in a really long time. There's a company called Alamira Sciences. It's in the healthcare sector. It says drug manufacturer. I didn't even bother looking it up. It's also under $10. It's $3.75. It's got a good-looking chart. The $3.75 was a 30-day new high. The average daily volume, the volume had increased over the past 3 days. That's a good sign. It closed in the top 25% of the day. That's a good sign. And I just like the way that the chart looks. If any of you guys remember William O'Neill and the cup and handle pattern, he was describing a breakout that there's so many different definitions. I won't bother you with it. But anyway, it would also qualify as under that. And a Boise Cascade, I'm not a huge fan of Boise. It's a big old company in there in the lumber and wood production. But man, this thing's been popping up. It came up on the scan initially. Let's see, what date is that? 5/5/23, so May 5th. It's up 41% since then, and that's a big company to move the share price that far over that short of a time period, and it would still be in it. And it came up again today, and the price-to-sales ratio on that thing is 0.33. If you listen to my show for any length of time, you've probably heard me mention price-to-sales ratio before. And so 0.33 is pretty low. It's not low for the industry that company is in. Actually, no, it is. It's low for the industry that they're in. But as a rule, companies in the paper, wood, and pulp, and all that kind of stuff, they generally don't have really high valuations. And again, I'll start to work on some of these essays because, like everything else, I try to boil this down to just the most important and the things that you cannot do without. Okay? If there's something that you should be doing when you're investing, you got to leave it in. You can't pick and choose which ideologies or characteristics that ones that you like, and you're going to ignore all the others. Now you got to figure out which ones are most important, and do not leave them out, no matter how much you like or dislike, okay? Because this is your money. And it has your money. The rules, financial rules, don't care if they hurt your feelings. You have to learn not to pay attention to your feelings. I see people do that all the time. I don't want to invest in that company. I read the CEO did this or you know what? If the company, by the way, those companies are so highly regulated. If that CEO does something and gets them and it's not above board, he's going to get called out on it. Yeah, and it's going to happen. Doesn't matter. So if it meets all the other criteria, then maybe it would help to include that. That's one of the things I like about exchange-traded funds. They're mainly financial criteria. If the company's meeting all the requirements, and now there are some that will take ideologies and add it to the financial criteria. They're called ESG funds. But we'll have to wait until we're talking about funds again next week to go into that in more detail. In the meantime, if these companies like Boise Cascade came up, the first time it came up was in May, and it's already up 45%. That's a huge move for a company like that. Anyway, Thor Industries. I think you got to do that one just because the name Thor. I'm just kidding. I was a big Marvel Comics fan when I was growing up, and when that company came public, I was looking at the profit margins on the securities offering that they filed with the SEC. I had no idea how profitable comic books were. And the main reason that I was looking at Marvel back in those days, and by the way, it came up on the scan multiple times during its lifetime. It got bought out by Disney, by the way. You can't invest in it directly anymore. But I remember Wesley Snipes was in one of those, it was a vampire, and I can't believe I can't even remember his name. Anyway, I remember seeing this and thinking, that's funny. And, wait a minute, that's Marvel. And that movie grossed like $1.3 billion. This is way back in the day. Anyway, that gave me a clue. I don't have much time here, and I apologize. I will try to get to more. By the way, Amazon came up on the scan, so if you're interested in that, if you've ever liked that stock, the last one I'll point out is Live Nation Entertainment, symbol is LYV. And I hear the music. I got to go. This is Bill Bullington. Have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullinton Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullinton Capital Management, LLC.